Real estate metrics, there are a lot of them. And today we're going to discuss one of my favorite ones, which is an equity multiple. Now, you may not have heard of an equity multiple before unless you're an active investor, either a direct investor or a passive investor. But an equity multiple is basically another way of looking at return on investment, or ROI. So an ROI calculation and an equity multiple are similar. An ROI is done on a percent basis, and an equity multiple is basically taken as a decimal. And the way that you would look at it is you look at the cash that you've invested, and that becomes your denominator. So the equity invested is your denominator. So if you have a $1 million investment that you've made, then that goes on the bottom of the equation, of the ratio. And to get the numerator, you look at all the cash flow that you've got back over the years that you held your property, any capital return that you got during that time period. You also look at any refinancing proceeds that you got, and ultimately on a sale, you also take in the final return of equity, any cash flow that you received during that time period, and also the profits from the sale. So at the end of the day, if you calculate this over a 5-year hold period and you receive $2 million of total cash back, your original $1 million investment plus another $1 million from cash flow and profit over that 5-year period, you would do 2 million divided by 1 million, which is a 2x equity multiple. And if you've done that on a 5-year basis, then that effectively equates into about a 20% IRR for the investor equity. But the equity multiple is an interesting factor because it tells you how much more money you made over your equity. So a 2x equity multiple means you got your original investment back, plus you made 100% profit on that deal. So I hope you like this video on the equity multiple.